This is the discussion on chapter 39 in our last module. The most important matter here is on page 7, I believe, which is the discussion on advantages and disadvantages of the LLC. LLCs are basically partnerships that have turned into a company. There is a pass-through such as in partnerships where there is no tax to the company. Individual members, which is the name LLC is used for shareholders, are taxed individually when they receive income. And at the end of the year, again, everything is zeroed out so that whether or not the LLC takes the money, if they're holding it, it is then attributed to individual members per the nature of their split in the LLC articles. But do turn to page 7. I think when we're getting into these issues, we're not trying to, again, make you into attorneys. The course tries to give you a sense of what they are so that you can discuss these matters more detail with more detailed with your counsel in the future of your business needs. So what we're doing here is just comparing and contrasting. We've covered partnerships, limited partnerships, where there is a limited investment from the limited partner. We've covered a little bit of the corporate issues in terms of formation and the membership of those. And here is another unique entity that we can compare and contrast. The nature of LLCs that varies from state to state, though, is the problem. Sometimes the LLC members can be sued for individual professional malpractice. We'll deal with a little bit of the specialty LLCs in a minute. Sometimes they can't. It just depends upon the state. But many states have this new vehicle, this new type of entity available for people who want to conduct business, but in a limited way. They don't want to form a fully operative company. I know of many real estate divisions. If an individual wants to build a house, each house is its own LLC. That way, if there is some type of liability, all the investors have, those are the members, as liability for up to their investment, not beyond that, not personal liability, which is the wonderful thing about the LLC, that it has a corporate status. Unlike a partnership, the partners are liable if indeed the partnership is out of funds or not sufficiently capitalized. There's a way to reach behind the partnership shell and get to the partner's own personal assets in case there's insufficient capitalization in the partnership itself. So in this area, the good side is for the LLC, that the company normally is taxed, but the LLC isn't. It is, again, a pass-through for many purposes. So there's no what we refer to as double taxation. That is a concept that where you have a company, go back to another chapter, the company is taxed, and also then if it makes distributions through dividends to the shareholders, when they receive that income, they're also taxed. Here, though, the company is not taxed. Again, very similar to a partnership. The problem with an LLC is you have to learn some new terminology as far as how the owners work and who manages, but do think of it like a partnership and make that transition. It's not really easy to compare it to a corporation with the board of directors and such. It just doesn't fit. It fits more along the lines of a partnership. So you have members instead of partners. You have a managing member who basically runs the LLC, much like the president of the company, but more like a managing partner, actually, in terms of the ability to make decisions for the entity. There is such a thing as an LLP. This is on slide number 10. LLPs are going away in many states just because they're so similar to LLCs that there's really no purpose in having the distinction. These are mostly for professionals such as doctors and attorneys, accountants, anybody that deals in a white-collar service industry. And so because they're partnerships, they are basically there to limit the liability of certain individuals in the partnership from the liability of others in the partnership. So it's a professional liability issue if there's an LLP of accountants and there's one accountant who is professionally negligent, professional malpractice. That negligence does not basically move into the liability of other accountants. It doesn't make the other accountants liable for that one individual accountant's professional negligence. The partnership can still pay, but the other partners aren't going to have to pick up an extra tab, so to speak, or pick up that bill. It is not their liability. It just the one partner, the accountant whose malpractice is causing the problem. That one partner basically is paying for that liability, plus the partnership is paying for that liability, but the other partners can isolate their own assets separate from that. Their home isn't going to be sold away, their property isn't going to be sold away to pay for that one accountant's liability. So LLPs, and then again there's another entity called LLPPs, which are limited liability professional partnerships. But as I said, many of these are by statute going away because they're so similar to the LLCs. And the liability issue basically I have on slide page 12 in a highlight. That is it for our discussion for chapter 39. We're going to move to the next chapter.